Joining us for more on the markets is Kathryn Rooney Vera, the Chief Investment Strategist at Bulltick Capital Markets, and Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Good morning to you both. Andrew, I'll start off with you. Do you think the market's pricing in everything good and nothing bad here? We are going to open at record highs if we keep these gains in the futures.
Yeah, I do. But I think the market's going higher into year end because there's too much defensive positioning, and you get strong markets through October. The market tends to be even higher by year end. So I think we've got another 3 to 5% upside between now and year end. Although the market short term, very short term, is getting a little bit overbought.
Kathryn, how do you feel about the markets now, especially since of late, at least, we've gotten confirmation finally from the bond market? I mean, we've seen 10-year yields go to 3-month highs, 1.87 or so on the 10-year yield.
This is the melt-up scenario. So no more U.S. recession. That's certainly now consensus. It wasn't only 6 to 12 months ago. Consensus was for a U.S. recession. Now there is no U.S. recession. That's been my view for the past year. You have the Fed cutting, and you have a trade deal. So those three things are what took down the markets in December of last year. Now we have the melt-up scenario. Those are the three factors that needed to happen on a positive bend to get markets higher. Markets are going higher. I concur through year end. I think, however, that 2020 is going to present a lot of potential downside. That is why I continue, even at these levels and with the collapse in the VIX, the volatility index, to protect positions. I think there's a lot of complacency in the markets right now, and I think there's a lot of inherent risks going into the next few years.
What's a lot of downside, Kathryn?
Look, I think if you get an Elizabeth Warren nomination, this is something I've been talking about for a long time, in March, then you can get a big slide in the markets, 15, 20%. I think it's not priced in at, what are we at, 3,000, almost 100. Elizabeth Warren nomination and a potential presidency is not priced in right now. 49% of the S&P 500 is comprised of financials, big tech, and healthcare. Those are the three sectors that she most hard hit. So that is not priced in. The other thing that's not priced in is the potential for an economic acceleration eventually bringing about inflation, which means a less dovish Fed, a less dovish ECB, and a really risk to central banks having to undo heretofore massively expansionary policy, which has caused a buildup in negative yielding debt to $18 trillion globally.
Andrew, you're also worried about the political cycle and the impact on the markets in 2020, yet you like financials. Do you see this as sort of a limited window in which you can be in financials and see the upside before the political winds start hitting that sector?
Well, look, I don't agree with a 15, 20% downside because the reality of the election is if the economy is doing well, we reelect the sitting president regardless of what party he's from. I think the Fed cutting rates, the China trade deal, we will have a strong economy next year, and the market will reward that for a while. However, my job is to get ahead of it. I was on in September. I said I think the market's going to break out in the fourth quarter. I think the next speed bump, as your other guest said, is that you got to understand the sequencing of the primaries. The early primaries are going to go towards the more left-leaning candidates the market isn't going to like, and Super Tuesday is not for a good month later. So I think that's a speed bump, but I think the markets will be higher next year because the economy will be stronger. Whether this chase into year end, and that's what I think it is, I don't think people are going to buy utilities, REITs, and consumer staples. They are going to buy financials because they've lagged, although now they're getting a little overbought. And I think they're going to come back into technology, which recently has sold off. So I think it is the stocks that have more upside versus the defensives that you buy if you think the market's going down. I think so, yes, financials, but technology, consumer discretionary, which haven't done as well recently, I think they'll play a little catch up here.
So, Kathryn, you're the one.
Andrew,
go ahead.
Sorry, if Andrew takes that view, and I tend to agree with him, then he might agree with my position, which is protecting your S&P positions, protecting your financials have already run up quite a bit. I mean, 10-year treasuries have gone from 140 to almost 190 now. So we've seen the gain in financials. If you think that Elizabeth Warren is a risk, as I do, in the Iowa caucus and in the New Hampshire primary, first 2 weeks of February, she wins both of those. That's the potential. I'm not saying it's going to happen. It's a very big risk, however. She will run the table and be the nominee. So if you think that's a risk, then you want to buy today put options for March expiry, which get you through the next couple Fed meetings in the event that the Fed sounds more hawkish. It gets you through Iowa, New Hampshire, and it gets you through Super Tuesday. So if you think there is downside, I think it's actually 15 to 20%. I don't think at 3,100 Elizabeth Warren is baked into the numbers. And I also don't think that even with, I agree, economic growth is good for an incumbent president, but this is an unprecedented scenario where we are going to get the House impeaching the president. So I think there's a lot of volatility that is currently not priced into markets that we have to protect our positions for.
Well, look, Bill Clinton was impeached, the market went up because the economy is doing well. I agree there's downside, but the big downside comes in economic recessions, and I don't see that happening. Now, I'm not willing to commit to downside protection here because I think the market is going to rally into year end, and it's going to rally, the calendar year, just because the calendar year doesn't change, just because the calendar year changes doesn't mean the market doesn't continue. So I think this market is going to continue higher, and then it's going to take at some point in January start to think about this. I'm not convinced that's going to be the candidate. I'm just saying when we get into January, there'll be a lot more enthusiasm, and then that's the speed bump. So I'm not willing to commit here because I think I've got to stay offensively into next year first.
All right.
But I'm a portfolio manager. I can't. I have to decide when the timing. I was on in September. I said the market's going to break the upside. It has. I'm looking at the next move. I think it's too early to get defensive.